Every great innovation story begins with an idea, a breakthrough, a founder, a garage, a laboratory, a dream. But ideas have a problem. Ideas need resources. They need engineers. They need equipment. They need time. And most importantly, they need someone willing to fund something that might fail. For centuries, that was one of the hardest problems in business. Then, on a quiet road near Stanford University, a new solution emerged. A solution that would help finance thousands of startups and reshape the modern economy. This is the story of Sand Hill Road, the place where risk became an industry. Imagine you're an entrepreneur in the 1950s. You have a breakthrough idea, perhaps a new semiconductor, a new computer technology, a new scientific innovation. Where do you get money? Banks are unlikely to help. Banks prefer predictable businesses, established companies, reliable cash flow, collateral. Most startups possess none of those things. Your invention may be brilliant, but brilliance does not guarantee repayment. Historically, entrepreneurs relied on personal savings, family wealth, wealthy patrons, corporate sponsors, or pure luck. Many ideas never left the drawing board, not because they lacked potential, but because they lacked funding. The challenge wasn't invention. It was financing uncertainty. A common myth suggests that Silicon Valley invented venture capital. It didn't. Long before Sand Hill Road became famous, investors were already funding risky ventures. Organizations such as the American Research and Development Corporation invested in emerging technology companies decades before the internet era. Wealthy individuals had financed ambitious projects for generations. The concept wasn't new. What was new was what happened in the Bay Area. Instead of treating startup investing as an occasional activity, Silicon Valley transformed it into an ecosystem, a system, a repeatable process, and eventually an industry. Why here? By the 1960s and 1970s, something unusual was happening around Stanford University. The region already possessed several critical ingredients. Stanford produced talent. Semiconductor companies produced opportunities. Entrepreneurs launched startups. Researchers generated ideas. What was missing was capital specifically designed for uncertainty. Traditional investors often struggled to evaluate emerging technologies. Many opportunities seemed too risky, too experimental, too unconventional. Yet a growing number of investors began recognizing something important. The future would not be built by certainty. The future would be built by calculated risk. Over time, venture capital firms began clustering near Stanford. Many established offices along a road in Menlo Park, Sand Hill Road. At first, the location itself wasn't magical. It was simply practical. Investors wanted to be close to founders, close to engineers, close to researchers, close to opportunity. Proximity matters. A founder could pitch an idea in the morning, meet a lawyer in the afternoon, recruit an engineer in the evening, and continue refining the company the next day. Distance creates friction. Sand Hill Road reduced it, and as more firms arrived, the effect intensified. The reinvention of venture capital. The true innovation wasn't money. Money already existed. The innovation was how money interacted with entrepreneurship. The Silicon Valley model embraced several ideas that became enormously influential: high-risk investing, equity ownership, portfolio diversification, rapid growth, large exits through acquisitions and public offerings. Most startups would fail. Investors knew that. The goal wasn't avoiding failure. The goal was identifying the few companies capable of extraordinary success. One great investment could offset dozens of unsuccessful ones. Risk became manageable through scale. And over time, this model helped finance generation after generation of technology companies. Some of the world's most influential venture firms became associated with Sand Hill Road. Kleiner Perkins, Sequoia Capital, Excel, Benchmark. These firms funded companies that would reshape communication, commerce, entertainment, transportation, and information itself. But the deeper story isn't about individual firms. It's about feedback loops. A founder starts a company. Investors provide capital. The company succeeds. Employees gain experience. Some employees leave and start companies of their own. Investors fund them. The cycle repeats. Each success strengthens the ecosystem. The system becomes self-reinforcing. Perhaps Sand Hill Road's greatest contribution was cultural. It normalized uncertainty. For generations, financial institutions had been designed to avoid risk. Venture capital took a different approach. It accepted risk as the cost of discovering transformative opportunities. This doesn't mean every risk was wise, or every investment succeeded. Far from it. But the system acknowledged a fundamental truth. Many world-changing ideas look unreasonable at first. And if nobody funds unreasonable ideas, some of the future never arrives. Throughout Bay origins, we've seen the same pattern emerge repeatedly. The gold rush rewarded risk-takers. Levi Strauss built infrastructure around opportunity. Wells Fargo created systems that enabled growth. Stanford connected talent with ideas. The semiconductor industry transformed breakthroughs into products. Now we arrive at another critical institution. Sand Hill Road did not invent venture capital, but it reinvented how venture capital interacted with innovation. Instead of funding isolated companies, Silicon Valley increasingly funded ecosystems. Ideas became startups. Startups became industries. Industries produced new founders. New founders generated new ideas. The cycle accelerated, which brings us back to the question at the heart of Bay origins. Why did it happen here? Perhaps because the Bay Area became one of the first places where risk itself was systematically organized, financed, and scaled. The innovator's ledger. Lesson 1. Capital is a technology. Most people think of innovation as software or hardware, but financial systems can be innovations too. Venture capital changed how ambitious ideas received funding. Sometimes the platform matters as much as the product. Lesson 2. Proximity creates advantage. Sand Hill Road succeeded partly because investors stayed close to the people building the future. Relationships move faster when distance disappears. Ask yourself, am I positioned close enough to opportunity to recognize it early? Lesson 3. Ecosystems compound success. The Silicon Valley model didn't merely fund companies. It funded cycles. Every successful company created future founders, employees, investors, and mentors. The strongest systems generate their own successors. Founders question. Sand Hill Road became powerful because it helped transform uncertainty into opportunity. What promising idea in your industry is currently being ignored because it looks too risky? Closing. It was never really about the road. It was about what flowed through it. Ideas, capital, talent, ambition. For decades, Sand Hill Road became one of the places where the future went looking for funding. And in doing so, it helped transform Silicon Valley from a collection of companies into a machine for creating new ones. This is Bay Origins, birthplace of the future.